I'm here with Kenneth Masika, the Chief Executive Officer of Stanlib Fahari IREIT, the first real estate investment trust to be listed at the Nairobi Securities Exchange. He's going to give us and shed more light on how the IREIT has been performing.
I think as I start, I'll probably give you a history of sort of where the REIT has been. The REIT came into existence in 2015. We listed in November, coming back off an IPO where we raised 3.5 billion shillings. We then invested about 2.4 billion in our 3 seed assets, the largest one being Greenspan Mall out in Donholm, and then 2 smaller light industrial come office buildings in industrial area. The rest of the money was invested in fixed deposits, treasury bills, near cash investment in instruments in line with our investment policy. I think in this point is to say that investment policy basically looks at, while maximizing returns, what we're looking at also making sure that the money is invested in secure instruments. So when we listed in 2015, we then invested the assets over the period of 2016. 6 months into the year of 2016, we did our half-year results, where we had an unaudited distribution of 13 cents. Finalized the year in December, and then in 2017 April, we had our first AGM for the inaugural first year, where we paid out a dividend of 50 cents per share. That was in April 2017. So again, in June, we had finished our first half year for 2017. We announced a dividend return of unaudited, again, of 43 cents per unit. And as you recall, in March 29th, 2018, we announced the full year results at 75 cents per unit. So as you can see, there is an emerging positive trend.
Tell us, how bad was the 2017 year for you in terms of your projects?
By regulation, we were supposed to have been invested in at least 75% in investment property within a period of 2 years of the IPO. So around approximately in August, we realized we're actually at 68%. We've been trying to get properties into the REIT to grow it up from 68% to 75%. But one of the problems we're experiencing was actually concluding transactions during that electioneering period, because then you tend to have a start-stop. And one of the things we were very, very pertinent or very focused on was that to make sure that we get quality assets into the property. So we consequently went to the CMA, who are the regulators of REITs, and requested for an extension, because we felt it would not be prudent on our part as fund managers for the REIT to invest in a property we didn't feel was the best to put into the fund.
Give us more details about the asset, where it is, and what you're planning to do with it.
What we have always wanted to do is participate in the 4 large sectors, basically retail, commercial office space, hospitality, and light industrial. To begin with, we are not too keen on residential, just largely out of the fact that it has annual leases, and while the others have your standard 5-year, 3 months, or 6-year leases that have escalations. And so what we're looking at is that stability of income.
What are your other options? Where are you looking at going forward?
We are looking at one of the key sectors that's doing very, very well is light industrial, and especially grade A light industrial. If you look at what has been on the offering, it is the old traditional industrial area, be it in Nairobi, Mombasa, Kisumu. And what we found is light industrial tends to be perhaps not as sort of a picturesque or a standout building, like you get a nice hotel building or a nice office building, but factories and light industrial tenants, once they set up, tend to remain there. If you remember from history, all your industries that you know from industrial area are still there from our younger days. So that's a sector that we are looking at. We're also keen definitely in commercial offices. And provided they're grade A, we're careful with offices where we invest, because in certain areas like Upper Hill, Westlands, there is a bit of an oversupply of office space, but the takeaway from there is that there's not all that office space is grade A, and the demand we see is for grade A offices. In terms of grade A, what you're talking about is modern building, well designed, with all the amenities that an international client would be looking for: connectivity in terms of internet, adequate parking, probably a building management software that makes it efficient in terms of energy consumption, water recirculation, and the like. So those are the main sectors we are looking at. Hospitality, we are keen. We're seeing the government spending quite a bit of effort in attracting tourism to Kenya. Conferences have always been a large part of that, and we are hoping to play in the business segment of the hotel market. Your 3 to 4 star. That's where we feel there's a sweet spot for in terms of hotels.
Do you feel like there is a huge gap in low-cost housing in the country?
In terms of low-cost housing, definitely. That is an area that has been underserved by all the property players, be it from developers to contractors to real estate professionals. I think there's always been the belief that, one, the issue of defining what exactly a low-cost house was, who your potential clients would be for the uptake of those low-cost housing. There's also been an issue as to how would they do it, in terms of, do they have the adequate earnings to do it. Most of the low-cost houses, and if you look at the low-cost housing and the market that you're targeting, you'll then tend to find that they're the kind of they're the persons that would not qualify for a formal mortgage structure. So what we're seeing is that definitely that has created a big gap. For low-cost income housing to work, you'd find land has to be affordable, which means you'd have to be fairly out of town or in an area where the government has decided to allocate land for that specific purpose. You have to do it in a certain scale to benefit from the economies of scale and keep the price down. So obviously what you'll be creating is a sort of satellite city, if you will. Now, in that satellite city, you would have schools, you would have a shopping center, some sort of economic activities to enable the residents live there, so they don't have to come in and out to go shopping and the like.
Largely, just about the real estate sector. Where do you see it in 2018? We saw a dump in 2017 because I think of the electioneering period and the private sector credit growth that was stagnating. Where do you see it in 2018?
We do expect an appreciation in terms of capital returns for properties this year. There's also a talk about an amendment or review of the Interest Rate Capping Act. That has also resulted in banks being, or financial lending institutions being very selective in whom they lend, be it mortgages, be it development loans. And so what we are hoping is that with that review, there'll be more funding coming into that market to also meet the demand. And obviously, once things settle, you expect the government plans and projects of attracting investment, the oil export and the like. When those come in, then obviously you have an uptake in all the sectors, be it light industrial for storing their spare parts and the rest of it, to commercial offices for head offices, to residential for their expatriates. Now that demand obviously will drive prices.